The S&P and the NASDAQ posting their best day since early June yesterday. Joining us right now to talk about what to expect is Gabriela Santos. She is JPMorgan Asset Management Chief Market Strategist for the Americas. That's a mouthful.
That is, isn't it? Thank you, Becky.
Thank you for coming in, Gabriela. What do you hear from your clients right now? It seems like there's so much uncertainty that's swirling on politics here, on what's happening around the globe. What are the questions that you're hearing most from people? What are they wondering?
So we're getting quite a few questions. I think the first one on all of the political headlines we've been seeing, the first question we get is there any policy read-through from all of the changes in the upcoming election? And what we tell clients is a bit, A, too early to know the outcome, B, to know the true policy that's going to be implemented. And even if you do know that, it's hard to actually figure out what the investment trade or investment would be. For example, I think there's a lot of focus on deferring policies around energy, for example, between Democrats and Republicans. But actually what we saw under the Trump administration is that traditional energy was down 40%, clean energy was up nearly 300%, and vice versa under Biden. So we take all of the political and policy developments with a grain of salt. That said, the one big underlying read-through we see is higher deficits. The discussion is really just about the slope of that deficit, and that'll dominate all of next year. So one big implication for us is higher long-term yields, more anchored yields. And as a result, when we speak to clients about moving out of cash, taking on some duration, there's no need to go too far. So for us, a nice sweet spot is short, intermediate duration.
One huge question that we get from business leaders all the time is what will the regulatory outlook look like?
That's right.
I think there's been a lot of frustration with Lina Khan and the FTC and companies feeling like they can't do any type of merger. Would that change, especially, I think people thought it would change potentially under President Trump. There are some questions with J.D. Vance, his running mate, who seems to have some affection for what Lina Khan has done.
That's right. And that's a good example of not just it being too early to know the outcome of the election, but also what the actual policy would be. And I think for a couple of weeks there was this idea of a Trump trade, and part of the trade would be lighter regulation. And then I think at the end of last week, there was some questioning of, is that really the appropriate investment implication? There is a little bit more focus, I think more broadly on both sides of the aisle, and a bit more regulation. And where exactly that's focused might differ, but I do think there is a bit more focus on regulation, especially when it comes to large cap tech.
It's hard to think of more regulation when it comes to this front. I think that there's been a huge pushback from the business community at what they've been dealing with.
And I think what the object of what the focus is of that regulation might change. For example, we do think there's generally a desire to have a bit more focus on regulating large cap tech companies, but exactly what shape that takes or doesn't take. And including, for example, some restrictions when it comes to export towards China. So in general, it does seem like the attention is very much focused on large cap tech.
Okay, let's think of another thing that investors are probably talking about. You see these huge runs in the markets, and people have to wonder, will that growth continue?
That's right. And I think with a lot of clients we speak to, if they agree with our base case of a positive outlook for the economy, for still quite a robust earnings picture with a bottoming in margins, how do you actually implement that positive view? Given that you have large cap valuations at 21 times, you've had nearly 40 all-time highs. And I think that's where it gets a bit more complicated to actually implement a constructive risk-on view. We get a lot of questions about, well, is it large cap tech or is it small caps? And I don't think we need to go one pendulum or the other, frankly. Maybe that's a short-term trade of this violent rotation. But really what we're speaking to clients about is just broadening out. It's maintaining some of that large cap exposure, but broadening out the winners from AI, looking at other structural developments like innovation in healthcare, like industrial policy. So there are many more winners, but we can still look for them in the large cap, maybe mid cap space. We don't have to go all the other side to the extreme with small caps.
What about the Fed? We have kind of baked it in that the Fed is probably going to cut rates in September, unless there's some big switch in the data that we've seen to this point. Does that matter?
We do get a lot of questions around, yes, does it actually matter when the Fed cuts rates? I think there's quite a lot of exhaustion on this Fed discussion. I think the most important thing really is that the next move is a cut. We've really taken off the tail risk of further hikes from the table, and that's really what the December pivot was all about. And in and of itself, that's a more constructive backdrop for risk. That said, it does matter if they cut sooner rather than later, because we want Fed cuts to be proactive rather than reactive.
And I think you want the best of all worlds here, best of both worlds, where you get the rate cuts, but the economy hasn't seriously turned down.
That's right. And I think for the Fed keeps talking about this adjustment or right sizing of policy. So all we want is the Fed to lower rates from a restrictive territory into a more neutral territory. And I think that's an environment where the economy can keep chugging along. I don't think it would be a good outcome for risk markets if the Fed was cutting more aggressively, because then it is a sign of a bigger slowdown. And so in that way, you can't have both, best of both worlds there. And that's why it's too early for small caps. You're not going to get a huge cut in interest rates at the same time that you get a reacceleration in growth. It's just not going to happen. So a sweet spot, and there's still plenty to invest in, would be more the large mid-cap space.